Howdy, Jacob here. Today we're looking at FactSet Research Systems in the capital markets industry. 18.2 billion market cap, 19.2 billion enterprise value. Currently looking at pretty frothy P based on no other value, no other looks, but we do see that it looks like a very solid business, immense growth, over doubling over the last 10 years. And gross margin down from 10 years ago, but still 54%. Operating margin also down, but 30%. So that's very high. They do pay a dividend though. Return on invested capital looks quite significant in the mid-teens essentially. Their income statement shows majority of cost is cost of goods sold. Balance sheet has 493 million cash-like products with short-term investments. 1.2 billion long-term debt, 125 million short-term debt. So enough cash for that short-term debt, and then that 1.2 billion looks like they have leveraged some of that growth. 10 years ago, no debt to 1.2 billion in debt now. It's not terribly concerning given how much they have grown, but you like to look at free cash flow growing as a percentage as much as long-term debt. But again, if you have no long-term debt, everything's going to be percentage-wise much higher. But anyways, that 1.2 billion in long-term debt in relation to their free cash flow is roughly 2 years. So we're not concerned with that as long as they don't keep going into debt. And it looks like that's not the case. It looks like 1.4 billion was issued to make an acquisition, and since then they have allocated some of their capital of free cash flow to debt reduction pretty evenly, it looks like. So they have historically made large acquisitions when it's made sense, as much as here is 4 times free cash flow or something, but even historically, anywhere from 33 to 100% of capital allocation every couple of years. And so I will be presuming some free cash flow allocation to acquisitions, some to share purchases, some to dividends, and then some to debt paydown. But at this point, debt paydowns 2 years of their free cash flow, so that'll be a very small portion of the capital allocation that I think about in my assumptions. So let's get right to it. As for revenue growth, there was a huge acquisition in 2022. We see a little bit of growth, not as much as I would have thought. So with some money going to acquisitions, maybe 10, 15% or so, I think that they can probably grow 6%. And then for margins here, they've averaged roughly 24 and 28% historically. I love that free cash flow is consistently higher. I kind of like that. I'll probably stick with that. Let's do 24 and 28 with a share change of 63 million in stock-based compensation, assuming 100% of those get turned into shares. They can buy back quite a bit more than that. So let's say 1% for them is about 182 million. And I don't think they're buying 240. Well, yeah, I think they can buy 240 million. That's pretty reasonable in comparison to their roughly 600 million free cash flow. So that's less than 50%. Maybe 40% going to share repurchases. We're already at 60% because we have like 5% to debt, roughly 15% to acquisitions. So that's leaving roughly 40% or so to the dividend, which should have them at 240. So they can definitely afford this dividend. Let's increase that. What have they done historically? Pretty solid. So I think I can increase that a little bit greater than their revenue projection. And then for P, price to free cash flow, do a little bit above market here, which might be an understatement. So super high return on invested capital, super high margin, 6% growth rate. I'll probably put it at an 18 actually. And based on all these assumptions, we're still saying it needs to fall more than in half to get the return we look for here. But based on the numbers, everything I'm seeing from a business standpoint makes it look like a very good company. I'd prefer the gross margin and operating margin to be going up over the last 10 years, especially with the revenue growth going up. But still very happy with everything that's been going on. Immense return on invested capital. But again, they're giving a lot of their money back to shareholders through share repurchases and to a little bit to debt reduction, dividends. And so they're not reinvesting to get those historical rates of return. If you're reinvesting back to get the 30% rate of return, I think that deserves a massive premium. But here we're seeing roughly 80%, or at least I'm assuming based on their historical allocation, about 80% to dividends and share repurchases, which to me don't necessarily deserve a premium in excess. But 18, I still think is a reasonable P in price free cash flow, and it needing to fall 62% is kind of where I'm at right now. So not quite at the price that makes sense to me, but hope you enjoy this video. Great company, and I hope you have a great rest of your day.